Diamonds are forever, but higher for longer by no means a given. Hi, everyone, and welcome to another episode of Insights brought to you by Ainsley Bullion and the Gold and Silver Standard. Today, welcome back Alex, who's been pondering whether US Treasury Secretary Yellen just gave the first indication that the Federal Reserve may need to revisit their current bullish trajectory on rates. Could we be at the pivot we've been waiting for so long? How's it going today, Alex?
It is going very, very well. Interesting that Yellen, who's talked about no recession, talked about all sorts of things for ages, just gave something little away, I think, finally.
So that's where we start. Is the pivot here? We've been waiting.
We've been waiting, and today's news was basically what you and I have been talking about is just getting more and more extended. The shorts in treasuries are more extended. The DXY, for the second time since 1967, the first time in 2014, just hit 12 weeks of consecutive higher highs. So it is just getting, this elastic is stretching and stretching. And Yellen today got up and said, higher for longer is by no means forever. So diamonds are forever, assets are forever, gold is forever. But we're at a point now that, these higher rates, higher longer is not necessarily going to be what happens. And it looks like, Yellen just gave that first indication.
And it's been something that we've been sort of back and forward on, and we're just trying to get our heads around because we know something has to give, and we're not quite sure because it's been very difficult because you've had what were previously uncorrelated things becoming correlated and previously correlated things becoming uncorrelated. So a lot of the playbook that's worked for the last 30 years or more has broken down and doesn't work anymore. It's been a really confusing time. And I think you might have hit the nail on the head by just saying the stretch, these things will probably snap back to some form of reality and some matching of what we would expect with correlations, but we just haven't seen it. So let's dig into that a little bit with the dollar, like specifically what's going on there, because that record sort of high after high after high, that has to be surely the example of stretch to as far as it can go.
Well, I mean, it's the Japanese yen, it looks like the Bank of Japan intervened last night because the because the Japanese yen went back down. It went up, the US went down compared to it. But, it hit 150. Everyone was talking about the BOJ intervening. It looks like they haven't announced it, but it's just going back up again. So, we're getting to the point now where everything in the US is causing so much fracturing worldwide. So you and I were talking before about the US debt. So 456 billion, I believe, has been added in 2 weeks. So $500 billion in 2 weeks has been added to these crazy deficits. They're now issuing bonds at 5%. They just can't afford this anymore. And the more they spend, the more they have to pay back, and the higher their interest costs are, and the more the US dollar is rising and pushing down, currencies like the yen and the Australian dollar and the euro. They are, dropping pretty significantly to the US, and the US appears to be going into a debt spiral. They've gotten rid of McCarthy today because McCarthy was the one that gave them the unlimited debt ceiling. But what's gonna replace it?
And this is what's so hard to understand, because if you objectively looked at it, like if you're an alien looking down on the planet and you went, if you've got a country that is just printing and really debasing their currency with such abandon, really, they're not. It looks like there's no real care. I mean,
because they don't care, because it's strengthening. Why
we talked
care?
about the shutdown, right? Potential that sort of got narrow. Well, let's say not necessarily avoided, because it's temporarily avoided. It just pushes it back, which is part of the game that they play. But you see this going on, and logically, you would go, well, you would expect that country's currency to be destroyed, right? Like you expect the pressure to come, and we quite possibly will see that coming ahead, but we haven't seen it yet. We've seen the opposite reaction which could be flight to safety. Like how do you square that circle?
Well, I mean, you're better at this than I am, but you've got the stock markets dropping, so people are selling stocks and they need US dollars to sell the stocks. So the US dollar goes up while stock markets go down too. So, and then, buying treasuries, you need US dollars to buy treasuries. And why wouldn't you returning 5 and 6%? Like, it's just people want US dollars because US dollar is returning such a high return.
And I suppose our argument then comes around to the sustainability of that, which is your stretched, the elastic stretched analogy. Because
well, you've taken money away from Japan, right? So look at Japan, it's a very big economy. They're at negative 0.1%. What happens when they just normalize to maybe 1%? People are going to want their money back from the US because the differential becomes so much less. And at what point does that happen and what effect does that have?
Yes. And that's what we need to be paying attention to and really cautious of, because if you jump on the trend at the moment, you've got to be really careful that trend could be coming to a very sharp reversal as some of these other consequences come to play, which I think is a good segue into.
That's the issue, right? Like you and I talk about this elastic becoming more and more stretched. The snapback becomes bigger the more stretched it becomes. And right now, unprecedented DXY, unprecedented shorts in treasuries. Like it is getting to this snapping point where something big will react.
Yep. And remembering, with following that analogy through, often the reaction is overshoots in the other direction. Like that's what we regularly see when you do get that snapback, because it just, whether it's shorts being liquidated or longs being liquidated, whatever happens, you get a lot of turmoil in the market, people forced to sell, forced to buy, all sorts of chaos that pushes it further than expected the other way as well.
Yeah. So, you look at the Australian economy for the moment. We've got pretty good unemployment. It's rising a little bit, but very strong. Our house prices are still really high. Our asset prices are high. But we're starting to weaken. Our dollar's weakening because of it. So our inflation is now going up faster than the US through no fault of our own, because
purely on the back of the currency.
Weakening. Purely on the back of the currency and, possibly the oil price, which again, with the US running down its oil reserves and capping its output. So I believe their output is down 1 million barrels a day. Just so much of the impact happening in Australia right now and worldwide is because of the US. Right now, we shouldn't have inflation where it is. The RBA should be considering cutting because everyone knows everyone's in starting to really feel things. But the only thing they can look at right now is still rising. Like they didn't do it yesterday. They still aren't talking about cutting. They're still talking about maybe having to go up. And this is, through a weakening domestic conditions.
And I mentioned this yesterday, actually, when I was talking to Branko, but there was a leaked memo that came out from the RBA as part of their deliberations. It was effectively talking about all the people that call up the helplines for financial assistance. And it was a marked increase in the number of people in 6-figure salaries. So it wasn't your typical, lower end of the market earners. It was people who were earning very much middle to upper middle incomes that were under stress. And I think I saw another article talking about this, might have been in the Australian in the last couple of days, people having to defer things like working with the ATO, trying to defer tax payments, all these things that were happening because that stress is very much real. So it's certainly on their radars. They don't talk about it. I mean, that's why you only hear about it through the leaked memo. They're not going to talk about it because they're trying to push it in a certain direction. But they have to understand that it's real and it is impacting lots and lots of people.
Yeah, even I saw something today that current credit card defaults in the US, going back there, at a record high, never been seen before. So 7.51%. That's being felt over there, but they are collapsing, I guess, world currencies. And so it's even more exaggerated elsewhere. So
Yes. Yep.
the pain that is going through the market right now is pretty unprecedented. And yeah, this elastic is just getting longer and longer.
So just probably to wrap this up, I know you were talking about some other assets there, but how do you view the outcome here for hard assets? So when we start talking about the metals, obviously something we're interested in, but also property and, any of these other real sort of hard assets in an inflationary, or it's not necessarily even inflationary environment now. We're just talking about in this really stretched
interest
environment.
Rates.
Yeah.
So look, if interest rates stay up, asset prices will go down. But when you're looking at assets like gold at the moment in other currencies, they are holding up so well. They're record highs in Japanese yen. We saw $3,000 an ounce in Australia probably about 2 weeks ago. We hadn't seen that before. So we are seeing record highs in commodities in all other currencies except for the US dollar. So the only reaction is if the US dollar drops, these hard commodities need to go up. So whether that's housing or gold or housing is leveraged. So maybe the way to look at it is leveraged assets and non-leveraged hard assets.
Yeah, that's
so
a good point.
Non-leveraged hard assets like commodities, should go up. Highly leveraged assets, unless the interest rates correct itself, will eventually go down.
Yeah, that's a really good point. And I think the only thing I'd add when talking about gold specifically, we've seen it really pull off quite aggressively in US dollars, but that's kind of your point in motion with in Australian dollars. It hasn't been an aggressive. It's down, but it's not aggressively down like when you look at the chart.
I think in Aussie dollars, we're probably down 3%, but in the US, we're probably down 15%.
And that's really just that currency effect.
Yeah. So look, there's a lot of things going on right now that the US is causing, a lot of issues in the government. There was a really interesting article I read about the Mexican government yesterday, got up and said, the border crisis in the US is their own fault because they've got sanctions on Cuba and Venezuela and everyone's getting out because people are, really suffering in these other countries. So,
well, it's a double whammy there, isn't it? Because they're getting hit with the sanctions, but they're also getting hit with the impact of, again, that higher US dollar.
Yeah, the US dollar had, the US immigration's been like 2.2 million in the last 9 months or something insane. Like we're 500,000, which is enormous, but they are being absolutely creamed as well with a lot of refugees, Europe as well. It's just, crazy what's going on. And the snapback, like we've talked about, and maybe the pivot finally that Yellen's talking about will finally happen.
Well, Alex, you've really painted quite a broad picture there for us today. So thanks as always. I really, really like digging into that with you. It's always very thought-provoking. So thanks again.
Well, thank you for having me. I enjoy talking to you.
Yeah, we could talk about it all day, really. But anyway, thanks everyone for watching. Remember, you can reach out with any questions or comments on those social platforms. And that is us for today. We'll be back tomorrow with Sam to discuss all things markets and metals. Until then, have a great rest of the day, everyone.